In this module, we will discuss about input tax credit. We will discuss the meaning of input tax credit, what are the conditions to claim the input tax credit, and how you can claim the input tax credit for your business. To begin with, let us understand what does the term input tax mean. Input tax means the goods and services tax charged on any supply of goods and services used or intended to be used in the course of furtherance of business. While we now understand the term input tax, let us see who are the people who can claim input tax credit. So first and the foremost is all the registered dealers are eligible to claim input tax credit. A person who has applied for registration within 30 days of becoming liable for registration is also eligible to claim input tax credit. A person who has taken voluntary registration will be able to take the input tax credit. And finally, the person who has switched from the normal scheme to the composition scheme can also claim credit of input tax paid. While we discussed who are the people who can claim input tax credit, let us now understand what are the conditions for claiming input tax credit. Input tax credit is allowed only if the taxpayer is in possession of a valid tax-paying document which is issued by the supplier. The taxes should have been actually charged and paid. The return should have been filed on time. And finally, the goods and services should be received. If all these conditions are satisfied, then input tax credit can be claimed by the business. Now let us move on to discuss the features of input tax credit. Unlike the current tax regime, under GST, you can claim input tax credit on all the types of tax. The first and the foremost feature of input tax credit is that under GST, input tax credit are allowed on capital goods as well. In case of supply of goods made in batches, input tax credit can be claimed only after receipt of last batch of goods. Next feature is that transfer of input tax credit is allowed in case of change in constitution due to sale, merger, amalgamation, etc. Thus, the input tax credit of the amalgamated or merged entity is allowed in case of GST. In case where goods or services are partly used for business and partly for non-business purpose, or where goods or services are partly used for taxable supplies and partly for non-taxable supplies, including exempt or zero-rated supply, in such cases, input tax credit is allowed proportionately in the ratio of the business and non-business use or taxable or non-taxable supplies. It is very important to note that there is a time bar under GST law for claiming the input tax credit. This means that input tax credit on an invoice after the expiry of 1 year from the date of issue or filing of annual return, whichever is earlier, is not allowed. Further, input tax credit is not allowed in case of capital goods to the extent of depreciation claimed on tax component of the capital goods under the Income Tax Act. Let us understand this with the help of an example. Say for example, there is a plant and machinery worth ₹100. GST at ₹18 is levied on this plant and machinery. So, if depreciation amount is claimed on ₹118, that is the actual cost plus GST, then no input tax credit would be allowed. However, if depreciation is claimed only on ₹100, that is excluding GST, in such cases input tax credit would be allowed. And last but most important feature of input tax credit under GST is that Input tax credit will be confirmed only after matching of the suppliers and recipients' invoice details. In case there is a mismatch, then input tax credit would not be allowed, unlike in current regime. Let us now understand about the manner of utilization of input tax credit between the various taxes under GST. In reality, there are some limitations with respect to using the input tax credits. Input tax credit of Integrated Goods and Services Tax, that is IGST, is allowed to be set off against all the other taxes under GST, that is Central Goods and Services Tax, State Goods and Services Tax, and Union Territory Goods and Services Tax. Central Goods and Services Tax is not allowed to be set off against State and Union Goods and Services Tax. It is only allowed to be set off against Integrated Goods and Services Tax and Central Goods and Services Tax. Similarly, State Goods and Services Tax is allowed to be set off only against State Goods and Services Tax and Integrated Goods and Services Tax. It is not allowed to be set off against the Central Goods and Services Tax and the Union Territory Goods and Services Tax. And finally, Union Territory Goods and Services Tax is also allowed only against Union Territory Goods and Services Tax and Integrated Goods and Services Tax. It is not allowed to be set off against Central Goods and Services Tax and Union Territory Goods and Services Tax. This means that cross set off between State GST, Central GST and UT GST is not allowed. However, set off between State GST and Integrated GST, Central GST and Integrated GST and Union Territory GST and Integrated GST is allowed. With this, we end our module on input tax credits. In the next module, we will discuss about the input service distributors.